All right, a very good morning, very good evening, my dear students. Welcome to session number 7, which is on the residual income valuation. Residual income valuation is a powerful method used in financial analysis to assess a company's ability to generate profits above and beyond the expected return required by its equity investors. So, we all know about the standard utilized valuation methods such as the discounted cash flow valuation and some valuation models like zero growth valuation model, golden growth valuation model, dividend discount model, things like that. And residual income valuation actually comes as an extension of these methods, and it will be assessed as a method which will try to enhance the traditional uh, drawbacks that are usually identified with the conventional methods of valuation. So I know your exams are coming rapidly and you might be a bit anxious, but I can assure you that along with this, the remaining material will be uploaded to the Moodle portal soon. And if you would go across these materials specifically, then with the questions that I will be discussing, it would be surely an easy effort for you to score a good mark in your final examination. So, without further ado, let's start off with the session number 7, residual income valuation. So, let's have an introduction to the concept of residual income. Residual income or economic profit, so it is essentially the net income of a firm after deducing a charge that represents the opportunity cost of the capital invested by stockholders. So this means that the residual income would account for the returns expected by both debt and equity holders. So you can see the both parties involved with the overall asset construction of the organization is going to be interested with the returns of those debt and equity. So this is important or why this is significant as a concept? Because traditional accounting measures like net income usually do not consider the cost of equity capital. So in contrast, residual income would provide a more comprehensive view by including this cost, which would essentially give us a clearer picture of whether a company is truly generating value for its shareholders. So, with this understanding in mind, we need to identify the rationale of it as well. So, as we have discussed earlier, also, this recognizes the equity cost. So, unlike traditional accounting income, which typically only reflects the cost of debt, residual income actually recognizes the cost of equity of capital as well. So, this become crucial because why? Because equity investors expect a return on their investment just as debt holders. So, a usual misnomer in the industry is equity investors would not necessarily care about the return of their investment as much as the debt investors, but that is essentially not the case, and this aspect is essentially addressed by the residual income approach. So by acknowledging this, residual income gives a fuller picture of a company's profitability. So let's think it like this. If you invest in a business, you'd want returns that compensate for both the risk and the capital you have invested, right? So in that scenario, residual income measures if the company's profits exceed these expectations. And finally, positive net income isn't always enough when we consider from the perspective of both debt holders and equity holders. So a company might report a positive net income, but this does not necessarily mean it's meeting the expectations of its equity investors, right? So if the cost of equity capital is essentially high, the actual value created for shareholders might be minimal or even negative. So this underscores the importance of measuring residual income. And with these fronts, you can see how a nice foundation can be laid for the concept of residual income, of how significant it would be, particularly from the point of view of the equity shareholders. So we have a question right here. It says that the Axis Manufacturing Company total assets of £2 million. And what else does it say? It says that financing is done by 50% debt and 50% equity capital, and the cost of debt is 7% before tax, and the after tax cost of debt is 4.9%, cost of equity 12%, earnings before interest and tax or EBIT is £200,000, and the tax rate is 30%, right? So what essentially is the residual income? So the residual income calculation here is first we need to understand the net income. So EBIT, earnings before interest and tax, is 200,000, and it says that taxes are 30%, right? So tax rate, we can essentially assume that the taxes are 30% of the EBIT. So in that case, 200,000 into 30% would be what? 60,000. And net income would be EBIT minus the tax cost, which is 200,000 minus 60,000, that would be 140,000. And then we come into the point of view that the identification of the equity charge. And here it says that the total assets equals to 2 million pounds. And we know that financing is 50% debt and 50% equity. And when we take the standard accounting equation, we can understand that 50% of 2 million is going to be uh, 1 million pounds, and in retrospective the cost of equity is going to be 12% of this, that would be 120,000 pounds. And finally, residual income is going to be, since it accumulates the equity charge that has been incorporated, it's going to be net income minus equity charge, that would be 140,000, which is the net income we have just calculated, minus the equity charge, which we have calculated to be 120,000, and finally the residual income is going to be 20,000. So the calculation point up to this has been quite easier. We have all the data, but what exactly does this mean? So that's what you need to understand as experts, as analysts, as whatever the position that you are going to hold in the future. Because if you are not able to explain, interpret, or present the values that you have come into, although how rigorous and stringent your calculation methods and how precise they are, if you are unable to explain them, that's where you come into a problem, because in the corporate world, the leaders, the strategic uh, experts would not necessarily care about how you achieve the numbers as long as you are able to explain those numbers. So here we come into the result of residual income being what? 20,000 pounds. And residual income of 20,000 indicates that after covering the cost of both debt and equity, the company, Axis Manufacturing Company, is generating an additional 20,000 pounds. So this surplus shows that the company is not only profitable, but is also creating value for its shareholders beyond their required return. So always try to focus on how to interpret a certain value like we just did for this residual income calculation. And we come into a couple of important points under the residual income theory, which is EVA and MVA, economic value added and the market value added. So economic value added, or EVA, is a performance measure that calculates the value created for shareholders by management's actions during a given period. So EVA goes beyond traditional accounting metrics by incorporating the cost of capital into the evaluation of a company's financial performance. So essentially, economic value added is defined as a net operating profit after tax, or rather we identify it as NOPAT, minus a charge for the cost of capital employed. So you can see the equations are provided to you here in an explicit level. And here NOPAT is going to be net operating profit after tax. WACC, you know this, weighted average cost of capital. We have the marginal tax rate, which is designated by T. And then we have the total capital, which equals the net working capital plus net fixed assets plus book value of long-term debt plus book value of equity. So what would be the purpose of EVA? So EVA measures the efficiency with which a company utilizes its capital. So it highlights whether a company is generating sufficient returns to cover its cost of capital. So a positive EVA would essentially indicate that the company is adding value, while obviously the vice versa, negative EVA would suggest that value is going to be decreased, or it's going to be hindered. And then we have some common adjustments associated with the economic value added. Let's go over them briefly. First, we have the research and development expenses. So these are usually capitalized and amortized over time rather than being expensed immediately. So this would essentially reflect the long-term benefit. We can essentially associate with this, particularly with some practical examples. For instance, if we consider the research effort that's been utilized or expensed for a company like Pfizer or Johnson and Johnson or any sort of pharmaceutical institution, they would want to capitalize those expenses because their intention for having those expenses in the first place would be to put them into their profit in the long run, have a long-term benefit. So that would be the approach usually that would take for R&D expenses. And then you have goodwill. Goodwill is capitalized and it is not amortized. So amortization expense is added back to NOPAT and accumulated amortization is added back to the capital. And then you have deferred taxes. So only cash taxes are considered expenses under the economic value added approach. Deferred taxes are eliminated from the calculation. And then the inventory. So last in first out, LIFO. LIFO reserve is added back to capital and any increase in the LIFO reserve is again included in the net operating profit after tax or in the NOPAT. And then finally, we have the operating leases. So these are essentially treated as capital leases under the economic value added method to reflect their true economic cost. So consider these scenarios which are usually come in when you are trying to measure the value of a certain commodity. Then these would be the method that will be taken under when you are going to calculate the economic value added. So then we have the market value added. So what would be the difference? Market value added is going to be a measure of the value created by a company for its shareholders since its inception. Here's the keyword, since its inception. So it would compare the market value of a company's debt and equity to the book of value of its invested capital. Again, the keyword being book value of its invested capital. So essentially, you can define it as like this. It will be defined as the difference between the market value of a firm's long-term debt and equity and the book value of the invested capital supplied by the investors. So essentially, it would be market value minus total capital is going to equal for the market value added, MVA. So we have an example right here, VBM Incorporation. It reports a NOPAT of $2,100. You have a weighted average cost of capital of 14.2%. Invested capital beginning of the year is 18,000. Invested capital at the end of the year is 21,000. Market price of stock at year end is $25 per share. Number of shares outstanding is going to be 800. Market value of long-term debt at year end is going to be $4,000, and we are required to calculate the economic value added and the market value added. So let's take this example and see how we can measure these values. So I'm going to write some equations here. First, we are going to calculate what? We are going to calculate the EVA. And we are starting from calculating the average invested capital. In the beginning, the capital was 18,000. In the end, it was 21,000. So I will write it, and it's going to be 19,500. And then we are going to calculate the capital charge. Capital charge is going to be average invested capital into WACC. So we have calculated the average invested capital, which is 19,500 into your WACC, which is 14.2%. That is essentially 0.12. So this is going to be 2,769. And then we have the capital charge. Sorry, we already calculated that. Then we have the actually EVA value to be generated. EVA is going to be NOPAT minus capital charge. NOPAT is 2100. Capital charge is 2,769. So we are essentially coming up with a negative value of 669. So our economic value added is going to be a negative value. So what does this mean? So we have already interpreted what positive and negative economic value added amounts reflect to be. So negative EVA of $669 indicates that the company did not generate enough operating profit to cover its cost of capital, suggesting inefficiency in creating shareholder value. So that would be the economic value added. And now let's go over to calculate the market value added. So we start with the market value of equity. So that would be the price per share and the number of shares. I'm going to quickly refer back to the situation. Price of a share would be market price is 25, and then you have number of shares to be 800. So 25 into 800 is going to be 800 into 25, that would be 20,000. And then the total market value equals to the market value of equity plus market value of long-term debt. We already know our long-term debt is, that would be 4,000. So that would be 20,000 plus 4,000 is going to be 24,000. That would be what our market value, or rather the MV total, 20,000 plus 4,000, 24,000. And then the total invested capital equals the ending capital, that would be 21,000. Total invested capital is going to be 21,000, and then we are going to calculate the MVA, which is going to be total market value minus total capital invested. That would be 24,000 minus 21,000, and our market value added is going to be $3,000. So what this is going to be, instead of a negative value, now we have a positive value. So this positive $3,000 indicates that the company has created additional value of 3,000 over the invested capital, reflecting effective management and value creation for its shareholders. So you can see, with the approach that we take to calculate both EVA and MVA, different interpretations could be made. So again, going back to the different treatments that we do for some of the EVA considerations like research and development, deferred tax, and the expectations of the shareholders, you need to make sure that the correct approach and the correct method is utilized when you are going to calculate EVA or MVA. All right, I'm going to quickly remove this. And I hope now you have a clear idea on what the concept of EVA and MVA would mean when it comes to the residual income valuation introduction. So now we come into the residual income valuation formula. So you don't have to by heart this by yourself when you are going to make certain calculations, and I'm going to provide you a little bit of a hint here. You will be getting a question on residual income on your final exam, and it will consist, a portion of it would consist applying these calculation techniques, but the majority is going for you to express your own opinions on certain figures and certain instances or certain behaviors. So since the majority is going to be expressing the concepts that you have learned today in practical applications, I will be providing you the equations in a separate sheet in your exam, so you do not have to by heart this. You only thing you need to do is understand how to apply these equations in the first place. So we do know what residual income is right now. Basically, it is a method used to value a company by accounting for the cost of equity, and that would be the most significant aspect of it. And it recognizes that investors require a return on their equity investments, not just debt. So the formulas provided here are fundamental to understanding how residual income is calculated and how it impacts the value of a share. So first we have the residual income expressed in a single uh, expression formula. So here we have residual income for time t. Then you have the E into T, that would be expected earnings per share for period T. And then you have R into uh, B in time T minus 1, that would be book value per share at the beginning of period T. And then you have the equal of that whole expression, that would be ROE minus simple r, where ROE would stand to return on equity. So here this formula essentially would showcase that residual income is the net income remaining after deducting the equity charge, which is the cost of equity times the beginning book value. And then you have the value of share today calculation, where we have the V into 0, that would be value of the share today, and then we have B in time 0, that would be book value per share at time 0, where T equals 0, and then B into T, that would be book value per share at any period of time T. Then in R, you have the cost of simple R, you have the cost of equity, and then you have the expected earning per share for period T as well. All right. So that would be how the residual income valuation is calculated using different uh, models, and how the value of share is calculated as well. So we have an example right here, and let's see how this is going to be applied. Here we have the bug properties example. Uh, it says that the bug properties institution has an expected earning per share of $2, $2.5, and $4 for the next 3 years. The expected dividends, analysts say that the expected dividend payout is going to be $1, $1.25, and 12.25 for the next 3 years. Note here that there is a significant bump of dividend payout from year 2 to year 3. And then you have book value per share, that's going to be $6 per share. And then you have cost of equity, it is stated as the rate of return on equity. And here we have three questions. First one would be calculate per book share value and residual income for the next 3 years. Estimate the stock's value using the residual income model given in the equation, which we have just discussed, and confirm the valuation estimate in part 2 using the discounted dividend approach, that would be estimating the value of a share as the present value of expected future dividends. So let's make an assumption here, otherwise it's going to be quite difficult to do. That would be the bugs operations, or the bug properties operations is going to cease after year 3, with the last dividend being a liquidating dividend. So you can see the key bump from year 2 to year 3 when it comes to the expected dividends, from $1.25 to 12.25 is a considerable jump. You would not see that unless there is a spectacular case or spectacular milestone is being involved. So here, as you can clearly see, we have come into that situation, and let's carry forward from here. First one is we need to calculate the residual income and the stock value, right? So we start off with calculating the per share book value and the residual income for the next 3 years. So let's get down to business and do this calculation step by step. And I encourage you to focus clearly on each of the steps to make sure that you understand them well, and you can somehow expect this sort of a testing in your final examination, where I will be asking you to calculate the residual income as well as interpret it based on a scenario like this, although it could include some additional information as well. So here we are going to start off with the per share book value and residual income. So year 1, we know that Ri, 1 is equal to 1 R B0. So I'm using previously presented formulas here to conduct this, and this would equal to year one. Since this is year one, I'm using the earnings per share of $2 into cost of equity 0.1 into current uh, share price, and that would be 140. And year two, I'm simply going to uh, write the equation here. This is going to be $2.50. And here it's going to be 6. Here it's going to be 6 point. Yeah, I will take another line here. It's going to be 6.40 because of the 40 cent, and that would be 1.86. And then year 3, EPS for year 3 minus cost of equity into share price of year 2. Sorry, this should be year 1, okay? And that would be $4 into 0.1. And in this case, the share price is going to take the accumulation of previous years. That would be $7.01, and that's going to accumulate for $3.30, right? So if we were to estimate the stock's value using the residual income model, so the application of residual income would be, we have calculated residual income, but if we were to actually conduct the valuation, then we need to value the share, right? The present value of the residual income needs to be calculated. So we now have the residual income for 3 years, and what we are going to do is conduct the present value of the residual income. So if we were to write this equation, V0 equals B0 plus sum of t equals 1 to 3, because we have 3 years, and then we have the residual income for each year, then we have 1 minus 1 plus r into t, right? So I'm going to write it out. V0 is going to equal to, so our starting share price is 6, then the first year we had a residual income of 140 over 1 plus 0.1 into 1, then we had 1.86 into 1 plus 0.1 into 2, and then finally we have 3 and 30 into 1 plus 0.1 into 3, and our answer is going to be, let me do a quick calculation right here. We have 140. All right, second year done, third year done, and we have $11.28 here, right? So that would be the value of this share for the Bugs properties, um, using these values provided, using the residual income valuation and using the present value of the residual income. So we understand the present value of the residual present value of Bugs properties under the residual income method is going to be what? $11.28. So go through this example. It's a fairly straightforward one. You had all the elements right here to calculate the residual income as well as the value of the share, present value of the share uh, as well. Every piece of uh, component, every component that was used in the residual income and the present value of the share equation models were given to you. So all you have to do is understand how to apply them and the rationale behind on how to apply them. So I will delete this out. Right. And then we come in to discuss the fundamental determinants of the residual income. So here we are going to delve into the core factors that drive residual income and how these factors can be used to value a company. So by simplifying certain assumptions, we can leverage models like the Gordon's growth model to estimate the intrinsic value of a company's stock. So we start off with the basic residual income model. So here you are given with the equation of P0 divided by B0 equals ROE minus G divided by R minus G. So if we were to interpret these figures, P0 would be current market price of the stock. B0 is going to be the book value per share at the initial time. That means when t equals 0. Then you have ROE, that is obviously return on equity. Then you have G, that would be growth rate of dividends and earnings. And finally, you have R, required rate on return on equity. So this would show the relationship between the price to book ratio, PB ratio, and the fundamental determinants return on equity, growth rate G, and the required return on equity, which is represented by R. So that's how the basic residual income model can be interpreted with as a uh, relationship between the PB ratio and its determinants of ROE, growth, and return on equity. And then you have an alternative model which can be constructed based on this. So that would be P0 divided by B0 equals 1 plus ROE minus R divided by R minus G. So this would give the intrinsic value of the share V0 by adding the current book value to the present value of future residual incomes. Again, focus on the keyword right here. This would gives the intrinsic value of the share, basically the value of the share by adding the current book value, all right, current book value to the present value of future residual incomes. So you consider the future residual incomes under the residual income method and you take its present value and the current book value is added to here to identify and comprehend the intrinsic value of the share in the period V0. So that would be how you can construct two different models with the determinants of residual income. And then we are going to consider some of the assumptions which are used in these models and how to simplify them in order to applicate them on more practical scenarios. So we start off with right here to go over these assumptions. We are starting with constant dividend and earnings growth rate. So by assuming a constant growth rate for dividends and earnings, we simplify the calculation of residual income. So this assumption allows us to use models that highlight the fundamental drivers of the residual income, which is the constant growth rate, or rather the growth rate. Here we are assuming that the constant growth rate is going to be applied for both dividends and earnings. And then Gordon's growth model. So the residual income model is akin to the Gordon's growth model. So if the same inputs are used, such as the ones which we have used, return on income, rate of return on equity, and growth rate, both models will provide similar value estimates. So this model is particularly useful for companies with stable growth rates. So we know with the practical application of the Gordon's growth model, we are considering on a continuous growth rate with the backing of its stable operations. So the same notion is being carried into applying this in residual income concept as well. And then you have return on equity, ROE, versus required rate return on equity, which is simple R. So if return on equity is equal to the required return on equity, it implies that the company is generating returns that exactly matches and meet the investor expectations. So in such a case, residual income would be zero, right? Because we are considering the income generated with respect to the invested capital by the shareholders, invested rather equity of the shareholders, not only the debt. So in that case, in a scenario like this, it would indicate that the company is not creating additional value beyond what is required. So always we are going to focus on what sort of an additional value, or if there is an additional value after all, considered and matched against the invested equity of the shareholders. And then you have another uh, approach or another measure that you can use, that would be this Tobin skew. It is interpreted as the market value of debt and equity divided by replacement cost of total assets. So what basically this is, Tobin skew would compare the market value of a company's debt and equity to the replacement cost of its total assets, or the total cost that would going to incur if the total assets were to be replaced. So a Tobin skew greater than 1 would indicate that the market values the company more than the cost of its assets, a good thing, suggesting that the company is expected to generate value above the cost of its assets. And conversely, you can see where this is going. A Tobin skew less than 1 would suggest that the market value is the company less than the replacement cost of its assets. That would be the company is expected to generate value below the cost of its assets. So the measures of ROE, the Tobin skew, and sometimes scarcely the ROA are often used as clear measures of the earning capabilities of entities, and that's why it has been used in the residual income concept as well, right? So let's take a quick example right here before moving on to the remainder of the residual income concept. So let's consider a simple case. You have the ROE of 15%. I will actually quickly write this down. You have ROE of 15%, constant growth rate of 5%, required rate of return of 10%, and B0 into $50, right? So what's going to be B0 right here? Book value per share at the initial time when the time is at t equals 0, right? So if we were to use the basic residual income model, that would be quite easy. Basic RI, that would be what? P0 divided by B0. So it's going to be what? 15% minus 5%, because we are going to deduct the growth, and same for the book value as well. That's going to be what? 10% into 5%, and that's equal to 2. 10 divided by 5. So here essentially the price to book ratio is going to be 2. PB is going to be 2. And now we are going to calculate the intrinsic value of the share, which is V0. So I will write down the equation. B0, sorry, B0 should actually be B0 plus return on equity minus required return minus G into B into 0, right? So the calculation is going to be quite easier. B0 we know it to be 50. ROE we know it's going to be 15%. And then you have 5 again into 50. So this is going to result in 5, then you have 5 again, 50, and that would be $100. So intrinsic value of the share is going to be $100. So that's a quick and easy example of how to apply this models in practical applications. A rather straightforward and easy example with all the values being provided to you, same as the one we did earlier. All right, let's continue forward. All right, continuing residual income from the point that we have stopped. So we have discussed the fundamental determinants of residual income. Then we have expanded it to understand the simplification of assumptions that is used in these residual income models. And here we are going to focus on the challenges residual income is faced and the strengths associated with the residual income models as well. So these concepts can basically be understood as expansions or enhancements of the fundamental idea of residual income. And let's going to discuss these as well. So as I stated earlier too, residual income valuation faces challenges when forecasting future residual income indefinitely. So to address these challenges, we are going to use multi-stage approaches similar to those used in dividend discount models and free cash flow models. So let's break down the key points on these uh, instances to understand how we handle continuing the residual income with the application of the strength and uh, certain detrimental impacts of the residual income approach. So forecasting future residual income. So what's the problem here? So problem would be forecasting future residual income indefinitely is challenging due to the uncertainties in long-term predictions, which is quite obvious, right? Because you would be able to predict how, let's take a gigantically larger than life example, Sri Lanka itself. So we can safely assume what's going to happen to Sri Lanka next week, right? We can basically say what would happen to the economy in next week, and that would be a fair assumption. But if we take long term, let's say 1 year from now, let's say 5 years from now, it is absolutely uncertain what the status and the situation of the country is going to be, and the same rationale is going to be applied for the companies as well. So the leading tech entities in the world, such as Microsoft, Amazon, Tesla, Nvidia, they are probably going to survive in the next 5 years. You can usually tell, but you can never know, right? You can never know what the future for these companies is going to be. With the rapid revolution of the artificial intelligence and its associated technical rise, you would never know which companies would come into place, right? Because at the end of 2021, OpenAI came like a storm, but before 2020, right, in the 2017s, 2018s, OpenAI was there, right? Its foundations was there, but no one knew, no one really knew, no one really cared, right? So the same rationale applies for organizations with the long-term predicability. So the solution is going to be we are going to propose a multi-stage approach where first we are going to forecast residual income over a short-term horizon that would be usually 5 years, and then make simplifying assumptions about the pattern of residual income growth over the long term after these initial years. Right. And then we are going to consider the simplification of the assumption. So to simplify this approach, we are going to typically make one or more of the following assumptions when you are going to continue with the residual income valuation with the consideration of the above challenges that we have just discussed. So first one would be residual income persists at current level forever. This assumes that residual income remains constant indefinitely. Again, a safe bet to calculate stuff, but not really useful under actual circumstances. And then you have residual income drops to zero. So this assumes that residual income immediately falls to zero after the short-term period. And then you have residual income declines over time. This assumes that residual income gradually declines as a return on equity falls to the cost of equity, eventually resulting in zero residual income. And then you have finally residual income declines to a long run average level. So this assumes that residual income declines to a level consistent with a mature industry reflecting a stable long term growth rate. So when we were discussing these four assumptions, mostly one of these are going to be utilized to continue the residual income valuation at the end of a short-term period, and let's see how they are going to be applied in practical aspects as well. And finally, we have another important concept that would be the persistence factor. So the rate which residual income is expected to fade over the life cycle of the firm is captured by this persistent factor, which ranges between 0 and 1. So you have two types of persistence factors actually. First one would be high persistence factor that would indicate that the sustainable competitive advantage and better industry prospects associated with it, suggesting that residual income will persist for a longer period. And again, as uh, always, the vice versa is going to be a low persistent factor, which would indicate less sustainability and more rapid decline in residual income. So, with the persisting residual income, we are going to assume that residual income remains at its current level indefinitely, and the formula is going to be something like this. Here, where the residual income of time t would be residual income at the end of the high growth period, year t, and then you have R, cost of equity, and then you have the persistent factor between 0 and 1. So this approach would assume that residual income does not decrease over time, making it simpler to project to the future, right? So it is going to remain at current level forever, the first assumption that we have discussed. And then we have it immediately drops to 0. You can see how the equation is going to be changed. And again, this approach is rather a conservative approach that indicating no additional value creation beyond the high growth period, but which is not really the case, right? So when we take companies, certain companies would have a rapid growth or rather a continuously high achieving growth, but still you can't necessarily say that right after that high growth period, you are not going to create more value, right? That's not a fair assumption, or that's not a fair thing to say, because that does not always happen. More often than not, your level of achieving those growth or your speed of achieving growth is going to hinder, but the level of value added is not necessarily going to be decline. So conservative approach, but still can be used as an assumption, same as the above one, where the residual income is expected to persist at its current level forever. And then we have the declining residual income over time. So this would assume that residual income gradually declines to zero as return on equity falls to the cost of equity. So again, uh, this would be a more realistic scenario where the company's competitive advantage erodes. So compared to the above two assumptions or above two considerations, this one is a more of a practical one, because usually over time, after a certain period of time where you come into the peak of your growth, then comes your diminishing returns, and you can necessarily expect for your currently existing competitive advantage to fade. For example, let's say something like Sri Lankan newspapers. If you were my age, and you're obviously not that much younger than me, so I'm sure most of you would probably remember back in 2010s and 2011s, Lankadeepa was the most popular weekend newspaper, and I kid you not, the copies would be sold out by the end of Saturday. So there was a practice of issuing Lankadeepa on Saturday as well, and stalls would be wiped out. People would essentially buy Lankadeepa as a newspaper. This is 2006 to 2011, 2012, and now what, right? Lankadeep has definitely lost its edge, and so does the newspaper industry. But more often than not, people would tend to go to a different newspaper, and I rarely see a person is holding a traditional Lankadeep newspaper, right? So this is a very generic case, but you can always see these kind of things happen in the real world, and how they would impact the overall performance and operations of organization. So this is why using the correct assumption uh, to continue with the residual income calculation in any given instance, and this is one of such areas. So that would be the third one, and finally. We come into the fourth assumption, which we have briefly discussed earlier also, which is declining to a long run average level. So here we are coming to the assumption with that the residual income declines to a long run average level consistent with a mature industry, And here, what we are going to calculate this is at any point in time t, the present value of future residual income is the difference between the market value, PT, and the book value, which is BT. And you have the PV of continuing residual income in year t in this calculation as well. So essentially, this method involves forecasting the price to book ratio and applying it to the book value at the end of the high growth period to estimate the stock value. All right. So this would be the overall approach of how these assumptions are used. And finally, uh, to make the approach consistent with the assumptions, the final one that we were talking about, which is the declining to a long run average level, we are going to incorporate the persistence factor into the equation, which you can see right here. This is the one. All right. So we have discussed uh, somewhat complex scenario, right? So we started off with understanding the fundamental determinants of residual income. Then we focused on the problem of forecasting in future indefinitely and how multi-stage approaches can be used. And to simplify the application of these multi-stage models, we are coming into several assumptions that can be used, one or more assumptions that can be used. First one is residual income is expected to persist at its current level forever indefinitely. Second one is residual income is expected to drop immediately to zero. Both of them are quite conservative, easy to calculate, but not really easy to replicate in actual world. Third one is residual income is expected to decline over time as return on equity falls and the competitive advantage erodes. And finally, residual income is expected to decline to a long run average level consistent with a mature industry. So you can see how each of these instances are modeled into different outputs, which you can see right here. Again, same as before, if you were to get a question on this concept, you will be definitely getting the equation with the question sheet as well. So without further ado, we have an equation, and once equation we have a problem for these equations to be applied, and once we do, I'm sure you will be familiar with the application of these assumptions into residual income calculation in a more effective and efficient manner. So we have the question of Java Metals. Java Metals is expecting an return of equity of 15% over each of the next 5 years. So company is Java Metals, return on equity 15% for the next 5 years, and its current book value is $5 per share. This is BO, and then you have dividends, none. All earnings are going to be reinvested. That is also clearly stated. And then forecasted earnings. Forecasted earnings in years 1 through 5 are equal to the return on equity times the beginning book value, right? So first we are asked to calculate the intrinsic value of the company using residual income model, assuming that after 5 years, continuing residual income falls to zero. So we are going to use the second uh, assumption that after 5 years, continuing residual income is going to be fallen into zero, right? Essentially this one. So let's go ahead and see how this can be calculated. We start off with earnings in year one, right? I'm simply going to put this as E1. Okay, so E1 is going to be ROE into B0, right? Because it says that years 1 through 5 forecasted earnings are equal to return on equity times the beginning book value. So this is going to be 0.15 into 5, 0.75. So book value at the end of year 1, which is B1, is going to be B0 plus E1, which is going to be 5 plus 0.75 equals $5.75. So what's the residual income for year one? We know this now. Residual income for year one equals earnings for year one minus return on rate of return into the book value of year one equals, sorry, this is not beta, okay, this is B, that's my bad, B, and this would be our earnings 0.75, and what's our rate of return? That would be 10%, and K, and this is going to be 0.25, right? And earnings in year two, so earnings in year two, same approach is going to be used. So I will start off with earnings with year two, the same formulas, same the applicable same values are going to be used. So in this case, it is ROE into the book value at the end of year one. So that's going to be 0.15 into what was the uh, book value at the year one we got. This is 5.75. So 5.75, that's going to be 0.8625, right? Okay, and the book value at the end of year two, that's going to be book value at the end of year one plus expected value, sorry, the earnings at the end of year two, that's going to be 5.75 plus 0.8625. So I'm not going to write because of the area that I have to write things. So that's going to be $6.6125. Same as earlier, we are going to calculate the residual income. We have earnings for year two minus rate of return into book value at the end of year one. So earnings is what? 0.8625 minus 0.1 into 5 and 75, and that would be 0.2875. And let's do the same. Let's do the same drill for year three as well. So in this time, I'm simply not going to write the equations. I'm simply going to write the answer. Earnings in year three, ROE into book value of year two, which is going to be 0.15 into 6.6125. That's going to be 0.991875. That's right. Then book value at the end of year three, book value is going to be book value of at the end of year two plus earnings in year three, that's going to be 66125 plus 0.991875, that's 7.604375. And then residual income for year three, again going to be an easier one, 0.991875 minus 0.1 into 66125, right? No, it's 6125. Okay, 6125, and that's going to be 0. 3306. All right. So I hope you are clear up to this, and let's continue to the year 4 earnings and year 5 earnings as well. I'm going to remove this part. Year 4, we have earnings. I will simply enter the value 1.1406. Book value of share at the end of year 4 equals book value at the end of year 3 plus earnings at year 4. That would be 8.7450, and then you have the residual income. Again, same equations are going to be used in each and every one of these instances. So it's going to be um, did I calculate it correctly? I think I did. Yeah, let me go back to the example first. Okay, let's see. It's gonna be 1.14065 minus 0.760437. So it's going to be 0.3038021875. Okay. All right. And then finally, year 5 earnings we know, but just to recap, I will write again return on equity, and this time what would be the book value of which year is going to be the previous year. That would be book value of the fourth year, and ROE does not change, 0.15, but we know the book value of year 4, that would be 8.7050, and earnings are going to be 1.3117, and book value of year 5 is going to be book value of year 4 plus earnings, so it's going to be 8.7050 plus 1.3117, and that's going to be 10.0567, and then you have finally residual income for year 5. What basically you need to do is you take your earnings, that would be 1.3117, minus return on equity, that would be 0.1, into your what? Your book value at the end of year 4, and that would be again 8.7450, and the output of this is going to be the answer for your residual income at year 5, right? That would be 0.4372. Yes, so residual income at the end of year 5 is going to be 0.4372. Right, so it was an extensive calculation, but you can see the simple equations were used. All we used was we started from the earnings from year 1, and then we continued forward, and finally we come into the residual value or the residual income for year 5. So if we move on to the second part of this, so I will delete this first. So now the second step is going to be what? Second step is the discount this residual income to present value, right? So if we were to discount this, then that should be done on having R as 10%. So what all we need to do is calculate the present value of residual income for all of the years, right? So let's do that quickly too. Again, remember, first one is calculate the intrinsic value of the company using residual income model, assuming that after 5 years, continuing residual income falls to zero, right? See, sorry, this one, but without a persistent factor. And here we now know the residual income of our uh, 5 years, and all you need to do is calculate the present value of it. And I will do the first one, present value of residual income 1. So you first have your residual income, that would be 0.25 into 1 plus 0.1, that would be 0.2273. And likewise, you need to continue until the end of the residual income of 5 years. So I already did this, so I will simply write down the present value of PV, PV of the residual income values of for these 5 years. So we have the first one which we done, and then you have the second one 0.2378, 0.2484, 0.2596, 0.2714, and then finally what we need to do is calculate the total intrinsic value, and intrinsic value is going to be V naught equals B naught plus sum of t equals 1 to what, 5 PV of Ri. So we know B naught to be what, 5, the sum of present value. So sum of all of these, and that would be 1.2445, 1.2445. So when we add 5 to this, that's going to be 6.2445. I will write it a bit clearly, 6.2445. So this is going to be the present value or of the Java metals, or the intrinsic value at year 0 for Java metals using the residual income calculation. That's going to be $6.24. $6.24. So by calculating the present value of the future residual incomes and summing these with the current book value, we determine that the intrinsic value of Java metals under the assumption that residual income falls to zero after 5 years is $6.24. So this method highlights how the future profitability above the required rate on equity contributes to the overall value of the company. All right, I will remove these parts again. So although this seems lengthy, all you have to do is focus from year to year, and then your calculations should not be an issue. So for the next two parts, I will leave it up to you. I can always share the answer with you, but I think this should be an easier one for you. So all you have to do is, in the second case, suppose we are going to change the assumption regarding Java's residual income after 5 years to assume instead that it remains constant at 0.44 forever. So what comes here? So what comes here is the it's going to be remained at a certain value, which is 44 cents forever. So what's going to be the new um, intrinsic value? So all you have to do is first you need to calculate the present value of the continuing residual income. That would be, since the residual income is assumed to remain constant at 44 cents forever after 5 years, we are going to use the perpetuity formula to find the present value of the continuing residual income at the end of year 5. So we identify that, and we are going to uh, calculate the total intrinsic value. So the first part is going to remain the same, the intrinsic value formula. The only one which is going to be added is the present value of the continuing residual income at year 0, because we make the assumption that the Java's residual income after 5 years will be remain constant at 44 cents forever. So that section should be added. So it is basically the intrinsic value of the above case, and what's basically added to is the present value of the continuing residual income. So that would be the intrinsic value if we come into this assumption that it is going to be residual income of the organization is going to be remained at 44 cents forever. All right, and then final one, the more realistic assumption that after year 5, Java's residual income will decay over time to 0 with a persistence factor of 0 0.4. So I was actually showing you this formula in our first example. It's not. This is the one we need to focus. Immediately 0. So here all you have to do is apply the persistent factor into your calculations and you should be golden. So what basically does is, by calculating the present value of the future residual incomes for the first 5 years and adding the present value of the decaying residual income with a persistent factor of 0 0.4, we determine the intrinsic value of the company, and it would highlight how the gradual decline in future profitability would affect the overall value of the company. So all you can assume is this would rather take a value uh, either similar or slightly higher than the value that we have calculated in our first example. That would be the intrinsic value would be fallen into 0 after 5 years, but under a more realistic example it's still going to be closer or slightly higher since this is 5 years. But if we consider a larger period, then the chances are it would be lesser than the first scenario. All right. So we have another example. So in this case, the Joseph Robien CFA is valuing the common stock of British Cornucopia Bank as of 31st December 2017, and when the book value per share is £10 and 62 cents. And in this effort, Robien has made the assumptions. What are the assumptions? EPS are going to be 20% at the beginning book value. That would be the beginning book value per share for each of the next 3 years. Dividends are going to be paid 40% of cash dividends, earnings per share. Stock price at the end of 3 years is going to be 4 times its book value. Beta is going to be 0.7. The risk-free rate is going to be 4.5%. Equity risk premium is going to be 5%. So what we are required to do is residual income per share in 2020 and the present value of continuing residual income as at end of 2019. So again, here also we can use the standard residual income model to our advantage. So all you have to do is to calculate the residual income per share in 2020 is simply do what we were doing earlier. But before that, we need to understand one key missing factor, which is what? If you would look closely here, you can see that one of the required determinants, right? Required determinants of R cannot be found here, right? It cannot be found here. So you need to calculate that. And how to calculate it? You can see your beta is given, your equity risk premium is given. So all you have to do is and also your risk-free rate is given as well. All you have to do is apply the capital asset pricing model and calculate for R. And once you do that, I think uh, uh, this should be 8% or something when I was doing. So you calculate this and then continue on with the same way. So you come into the earnings, then you come into the dividends, and then you calculate the book value. But the difference here is in this example, we have assumed that the dividends are going to be reinvested. But in this case, it is stated that dividends are going to be for cash equal to 40% of the earnings per share, right? So dividends would equal to 40% of the earnings that you would usually calculate. So that part is going to be deducted from your book value. For example, I will actually showcase you how to calculate the residual income for year one, so you can have an idea on this. Um, Here we start off with calculating the rate of return using CAPM. You have your risk-free rate to be 4.5. You have your beta to be what? 0.75, and your equity risk premium to be 5%. So when you calculate for R, it's going to be 8%. And now we are going to calculate your earnings for year one. You know this now. It's going to be 0.2 earnings into the starting book value, 10.62. That's going to be 2.124. And then dividends, D1, that's going to be 40% of the earnings per share. So you have 2124 into 0.4. This equals what? 0.8496. And then you have the book value at the end of year one, which is going to be book value at the beginning of the year, B0. Sorry, it should be equals earnings minus dividends. So you can do this quite easily. 10.62 plus 2.124 minus 0.8496, and the result is going to be 11.8944. And finally, we come into the residual income of year one, which is going to be again earnings minus earnings for year one minus rate of return into beginning book value. And then you have your earnings 2.124. We have calculated this to be 8% into 10.62, and this equals 1.2744. So the only addition was the dividend in this case, which is a considerably easy example. So do this for the 3 years and then calculate the present value, and that would be the intrinsic value of the shares for this CFA guy at the end of year 3. So you can see the application and the interpretation, both of them play a crucial role when we conduct a scenario with values, because you need to explain them to a certain audience. Right. And then we come into the strengths and weaknesses of the residual income model. So we have gone through the concept of residual income model in detail, and we have calculated certain examples here by heart. But what we need to make sure that we understand the certain benefits and drawbacks which are accompanied with the strengths and weaknesses of the residual income method as well. So we can start off with the strengths. First of all, we have the terminal value. So terminal values often make up a significant portion of the total present value in other valuation models. For example, if we take something like dividend discount model or even the most commonly used free cash flow, terminal value is going to play a significant role. But have you seen so far, the terminal values do not constitute a large portion of the present value when we are going to focus with the residual income valuation. All you wanted to play around or impact around is the determinants of the residual income, which we have calculated here: return on equity, the constant growth rate, and the rate on return, required rate on return rather. And yes, that's how terminal values could be a strength for residual income approach. And what the advantage actually this brings is this reduces the sensitivity of the valuation to terminal value assumptions, making the model less susceptible to errors in estimating the long-term growth rate. And then you have the strength and the advantage of readily available accounting data. So the residual income uses data that is easily accessible from a company's financial statements, such as net income and book value of equity, which are usually kept metrics for any publicly traded company, and even for some of the private entities where the data is publicly accessible. So this makes the model straightforward to implement and understand, as it relies on familiar accounting metrics rather than moving forward with the concept valuation approaches. And then its applicability to non-dividend paying companies. So residual income can be applied to companies that do not pay dividends or have negative cash flows. So we have experienced one firsthand, right? In this example, we have experienced where the earnings are reinvested and which says that there is no dividend. So this can be applied for such institutions as well. So this flexibility makes the model useful for valuing a broader range of companies, including growth firms and startups that reinvest earnings rather than paying dividends. So if you would focus on the standard discounted cash flow or free cash flow methods, it is not rather a suitable method to be utilized for growth firms and startup firms and the firms that are in a baby stage, baby development stage, because they do not have a fundamental cash flow to be estimated in order to measure their valuation. But residual income would be a great uh, alternate method to correctly value the intrinsic value of these type of entities as well. But going towards with these strengths, we have some def, uh, definite drawbacks and weaknesses associated with the residual income model as well. So the prone to accounting manipulation. In here, we identified the usage of readily available accounting data as one of its strengths, but again, accounting data can be subject to manipulation by management through creative accounting practices. So I don't need you to explain more about how certain firms cooked books, right? It's the industry jargon, cooked their books in the global financial crisis back in 2008. So that can be done. Even certain companies like Kodak did this to hide their losses. So this can be something which has happened in the history, which is strongly regulated, but it can happen. It can happen. So again, that comes across as a weakness for residual income valuation. So as a result of these manipulated values, it can lead to inaccurate or misleading valuation results if the underlying data is not reliable. And then the requirement for significant adjustments. So to apply the residual income model accurately, significant adjustments to the accounting data may be required to reflect the economic reality or the actual reality which is showcased by these data. So the issue here is this would increase the complexity of the model and require a deep understanding of accounting principles and financial statements. So again, you can see this could be counterintuitive in a certain perspective, and that is somewhat true, partially true, but you really come into these strengths and weaknesses based on the level of uh, management crew involved in this valuation process, the level of data, the access to data associated with the uh, organization. So all these factors would come across in order for a certain residual valuation approach to be a strength or a weakness against the valuation of a certain firm. And then the lean surplus condition might not be hold. That means that the model assumes a lean surplus condition where all items affecting equity are captured in the income statement, but in practice, not all items are included. For example, changes in accounting policies or certain comprehensive income items, which can distort the valuation. And then we come into an important one, which is a drawback for residual income valuation, which is the assumption about cost of debt capital. This means that the model assumes that the cost of debt capital is fully reflected by the interest expense, which is again not really the case in certain instances. It might not be always accurate, especially if there are other costs associated with debt that are not captured in the interest expense. So usually when we focus on the interest expense, that is essentially connected and explained with the overall cost of debt of an entity, and that's why the interest rate is essentially used as the cost of debt when you are going to conduct certain calculations, particularly in WACC calculations. But that could not be the case every time, right? There could be other type of expenses which are financial expenses but not associated with the debt of the entity. So we have an approach to take to determine when to use the residual income and when it shouldn't be used. So when should be used? When a company does not pay dividends, so residual income model is a quite suitable method. So it is suitable for companies that do not pay dividends or dividend payments are not predictable. So in that case, the reason or the rationale behind this is the model does not rely on dividend payments for valuation and making it useful for companies that reinvest earnings or have irregular dividend policies. So when the company is uncertain about the dividend plan that they want to incur, then residual income might be the model that they need to accompany themselves with. And then it is also appropriate when you have a negative cash flow. So the residual income model is appropriate for companies with negative free cash flow within the forecast horizon. It could be 5 years, 10 years. So the reason being the model values the company based on its ability to generate residual income rather than the free cash flow. So we are, sorry, so we are focused on the residual income rather than the free cash flow. So in that case, which could be negative for high growth companies. And then the uncertainty in forecasting terminal value, which we have also discussed as strength of the residual income model. So the residual income is useful when there is uncertainty in forecasting terminal value using alternative present value approaches. So by minimizing the reliance on terminal value estimates, the residual income model provides a more stable valuation framework. And when it is not appropriate. So the residual income model is not suitable when there are significant departures from clean surplus accounting, where all changes in equity are accounted for in the income statement. Because inaccurate accounting for changes in equity can lead to incorrect residual income calculations and valuation results, because the entire notion, entire idea of residual income is thoroughly accompanied with the excess return on equity that an organization earns and how the valuation is based on this excess return compared to the invested equity. And finally, residual income is not particularly suitable to be used when there are unpredictable key determinants associated with. So when key determinants such as book value, return on equity are not predictable, are not really measurable, then residual income model is not something you should going forward with the valuation of the organization, because every one of these instances, every one of these assumptions that we have carried over, things like uh, when the residual income is expected to persist at its current level, when it is expected to drop immediately to zero, when it is expected to decline over time, and the return on equity is going to be decreased, and the cost of advantage, or rather the advantage, going to erode. So all of these were based on the key determinants, right? Based on the key determinants, and if they are not really measurable or if they are not really achievable, then it is best to avoid from using the residual income model. And finally, we come into accounting issues in applying residual income models. So let's go through these one by one. First, we have the clean surplus violation. The clean surplus relationship states that all changes in equity should be captured in the income statement. So the relationship can be expressed here. Ending book value equals beginning book value plus net income minus dividends. So, this relationship may not hold if certain items bypass the income statement and are directly charged to the shareholders' equity. So, that's why we always come into the accurate determinants when it comes to measuring the overall earnings of the organizations. So, what are the common violations here? Unrealized gains or losses on available for sale securities. So these are recorded directly in equity and not through the income statement. And then you have the foreign currency translation adjustments. Changes due to the currency fluctuations are often reported in directly in the equity changes, not in the income statement. Then you have pension adjustments. Certain pension costs might be reflected directly in the equity as well. And then you have fair value changes of financial instruments. Gains or losses on revaluation can be again recorded directly in equity. Actually, that would be the most general case when it comes to revaluation of certain assets. So, what's going to be the impact here? Violations of clean surplus relationship mean that net income may not be correct, even though the book value is accurate. Uh, this discrepancy can lead to errors in residual income calculations. And then you have the variations from fair value. So, what this mean? To ensure accuracy, book value and income should be adjusted for the fair values of all assets and liabilities. So this would be including the inventory, that's usually the last in first out reserves, because adjusting the LIFO reserves can reflect the true value of inventory. And then we have deferred tax assets and liabilities. So these need to be properly accounted for to reflect their impact on future earnings. Then you come into operating leases. These should be treated as capital leases for a true representation of the liabilities. And then we have the special purpose entities. So these would they are to consolidate to reflect all assets and liabilities. And then you finally have reserves and allowances. So these are to be adjusted for bad debts and intangible assets to reflect their fair value. So these different arms of off-balance sheet items, their fair value needs to be adjusted in order to process with the residual income approach. Then you come into intangible assets. So intangible assets are often not recognized unless acquired in a purchase. So however, they significantly impact book value and income. So if necessary, you can adjust book values to reflect goodwill and other intangible assets like trademark or other type of intangible assets. And then you come into research and development expenses as well. So you need to carefully consider whether research and development is being capitalized or expensed. Capitalizing research and development can inflate book value and affect income in the short term. So this should be adjusted accordingly to reflect the true economic impact. And then you have the non-recurring items and other aggressive practices. Non-recurring items would be they should be excluded from residual income forecast as they do not reflect ongoing operations. For example, discontinuing operations. So income or losses from segments that have been sold or closed, these should be excluded from residual income. Extraordinary items, unusual and infrequent items. So for example, if there is an unexpected fire which has resulted in large number of losses, and you have made sure that fire insurance has been taken under, the fire resistance equipment have been implemented, fire resistance precautions have been implemented, and now we are 99% sure that it's not going to be happen anytime soon. So such instances impact to the net income should be removed from the residual income calculations because you are mostly sure and you are near perfectly sure that it's not going to be happening again. And then you have the restructuring charges, costs associated with reorganizing the company. Those should not be associated with the uh, residual income as well. So those are some non-recurring items, and at the same time you have aggressive practices as well. So you have accelerating revenue recognition, so recording revenue before it is earned. So that would essentially overstate assets and earnings, and such practices should not be incurred within the residual income approach as well. And also, like accelerating revenue recognition, you have deferring expenses. So, delaying expense recognition for future periods, such impact of those practices should not be associated with the residual income calculation as well. And then finally, you have the international considerations. What essentially mean here is different countries have varying accounting standards. So this could essentially affect the comparability of the financial statements. And if you are going for a residual income valuation for companies located internationally, then you have to consider the application of their financial policies and financial standards as well. Because in Sri Lanka, it is LKAS, which is essentially associated with the IFRS. But in the United States, it is GAAP, which is not significantly changed from the core ideology of the IFRS, but there are some changes. So if you were to value two entities, which one use GAAP and the other one use IFRS, then you come into an issue because the international consideration of applying the correct accounting standard is a key consideration. And then you have the adjustments for consistency. So when comparing companies internationally, adjust for differences in accounting standards to ensure consistency. Basically, uh, that's explains what I was trying to say in the previous point as well. So understanding and adjusting for these accounting issues are critical when applying residual income models, because ensuring accurate and reliable data will always lead to more precise valuations and better informed investment decisions. All right, so that comes to the conclusion of the session number 7, residual income. And I hope you all had a clear idea and clear insight on the ideology of the residual income and why it is used, when it is used, and the core concept of the residual income as a whole. So we have gone through several calculations throughout this session, and your final examination, as I stated earlier, you will be having one question from residual income. It is not necessarily going to be the entire question being a calculation problem. You will definitely have certain uh, opinions to be expressed, your own opinions based on the data provided to you, and you need to apply the concept that you have learned here into practical scenarios, particularly in the examination, in the one question that you are getting on the residual income. All right, hope you understood the fundamentals of the residual income valuation. So until next time, see you soon. Bye bye for now.